look, if Bitcoin can't hold a rally, then I don't know if any of the alts will be able to. But we shall see. I think it really hinges on what these equity markets do. If they start to bounce overnight, then maybe we've seen, an end to the selling for a little while in Bitcoin and ETH, but I still think they have more downside ahead. So basically, are we going to see volatility blow out? Are we going to see that? And tomorrow's a Friday. So, a big down day in the stock market on a Friday going into the weekend, that would generate a lot of fear, I think. And crypto markets trade 24/7. So I'm not closing my shorts just yet. I'm just thinking about like where and when and how much do I want to add if this bounce continues. That's basically what I'm thinking. And I'm thinking about that in risk unit terms. So remember we had that discussion. Let me see, is that video ready? Yes, it did. It completed. Okay, it completed 1 minute ago. With the final couple of minutes that we've got, I really want to play this video. This should be pretty interesting for us. Let's see what we've got here.
All right, today we are diving into a pretty wild DeFi strategy. We're talking about something from the Euler private credit facility that hints at a 20% APY. Now, this is really built for the big players, for institutions, but we're going to break it all down and make it super simple. Let's get right into it. So, let me just start with a question that gets right to the heart of this whole thing. What if you could get a loan for just 0.25% a year? Seriously, not some variable rate that could jump up on you tomorrow, but a fixed, totally predictable, and insanely low rate. This right here, this is the engine that makes this entire strategy go. And what is that engine power? Well, how about a potential 20.6% annual return?
Okay, so that 20% return, that assumes, only like 8% on your collateral, and you only use the very safest collateral, and you don't use max leverage. So if you take even a little bit more risk, you're up above 30%, no problem. And if you want to go max risk, then think more like 90% APY. So yeah, let's continue playing.
And get this, it's on assets that are supposed to be stable, like the US dollar. It sounds way too good to be true, right? Well, that's exactly what we're here to figure out. How in the world do we get from that tiny little borrowing cost to such a massive potential return? So seriously, how is a 20% APY even possible? It all kicks off with the very unique, kind of special environment that Euler has built here. Okay, the first thing you've got to understand is that this is not your typical wide-open DeFi playground. The Euler private credit facility is a permissioned environment. You have to be on the whitelist. So think less like a public park and more like a private, members-only country club. And that structure is what allows for cool features like fixed interest rates and knowing who you're dealing with, which is exactly what makes this whole strategy tick. To really get this, let's just think of the whole setup as a members-only bank. It has its own exclusive rules and, of course, its own exclusive members. And man, the difference is night and day. In regular DeFi, pretty much anyone can show up, and the interest rates are all over the place. But here, access is restricted, and because of that, borrowers get that beautiful locked-in 0.25% rate. That stability, it's a complete game changer. So inside this members-only bank, you've basically got three main players. First, you have the lenders. They're kind of like the people putting their money into a savings account. Then you have the borrowers, who are taking out loans against the assets they post. And finally, you have the liquidators. Think of them as the safety team, ready to step in if a loan ever gets too risky. It's a really simple, solid ecosystem. Okay, so we've got our exclusive bank with these super cheap loans. What are people actually borrowing against? This brings us to the second key piece of the puzzle. A very special type of collateral that we can think of as a crypto gift card. This gift card is actually what's called a Pendle Principal Token, or PT for short. Now, if you're coming from a traditional finance world, it's basically a zero-coupon bond. The idea is super simple. You buy an asset today for less than it's worth, knowing that on a specific date in the future, you can cash it in for its full face value. And this analogy just illustrates it perfectly. Imagine buying a $1 gift card, but you only pay 92 cents for it today. Now, you can't use it right away. You have to wait until its maturity date. But when that day arrives, bam, your 92 cents becomes a full dollar. That difference is your guaranteed profit. And that is the key. That predictable, locked-in profit is exactly what makes these PD tokens such high-quality, trustworthy collateral.
The system knows for a fact what they'll be worth when they mature, which makes them a super safe asset for this bank to accept. This built-in yield is the raw fuel for our entire strategy.